Hello everyone, and welcome to this very first event in the new series of Alpha Minds FinTech Leaders. So we created this series in Quantopian for the purpose of getting to know people who are visionaries and leaders in the space of FinTech broadly understood. And we're very happy, proud, and honored to have, well, someone who knows Quantopian better than anybody else, perhaps, who is at least listening to this. Thomas Wiecki, who is the founder, I'm sure that many of the listeners know already, but I will just provide a very brief introduction and then Thomas will talk more about his work and business and ideas and vision. He's a founder of PyMC Labs and the core developer of PyMC, which is a leading platform for statistical data science and analysis. He holds a PhD in computational cognitive neuroscience from Brown University. Is that with Michael? Who was the
Michael Frank, yeah.
Michael?
No?
Yeah.
Uh,
I know a few people because one of my master's students went to PhD in computer science, but of
no
course
way.
connections to other. Yeah, he was doing some reinforcement learning and things. So
Very cool.
from Brown, but he was previously a VP of data science and head of research at Quantopia. And he has delivered keynotes at ODSC and TACC and spoken at Strata, Hadoop, and AI, and Newsweek AI conference and PyData events worldwide. And we are very lucky and honored to have Camilo Saldarriaga, who is an economist and CFA level 2 candidate, joining us from Paris, believe it or not, in this early hours in the morning of Wednesday morning. He is a Bayesian enthusiast and data scientist, has two master's degrees, one in economics and one in financial economics, both from École d'économie de la Sorbonne, Paris University, and currently he is a PhD student in finance and ESCP Business School and École doctorale de la Sorbonne. So it is really our honor to have our guests here with us. I would suggest that we let them talk about their vision, their business, their ideas that they want to talk about for like 40, 45 minutes. Meanwhile, if you have any questions, please put those in the chat. And in the last 15, 20 minutes of the hour, I can start in order going over that questions, asking them, as well as you can unmute and ask those questions. So, Thomas and Camilo, floor is yours.
Well, thank you so much for having us and for the great introduction. Just to add a bit more flavor to it. In general, my career was always about making advanced analytics palpable and usable by people. So PyMC is the biggest effort in this endeavor to really allow people to build complex statistical models very flexibly. And this is what we're going to talk about today. But it's a special pleasure to be back at Quantopian, the second incarnation, as already was alluded to. So I was like the first employee back in, when was it? Probably 2013, 14, when there wasn't even a Quantopian office.
Yeah.
And then have been like with the company through its entire lifetime, seeing it go from like those three people sitting at the VC because we didn't even have offices all the way to like the exit. And yeah, some of the best years of my career, of my life, working with Foss and everyone else,
Yeah.
and especially the amazing Quantopian community and helping build that. So it always has been a special place. It still is, and I'm very happy to contribute to this effort and community. I have some more general notes on PyMC Labs, but maybe first, Camilo, also happy to hear more from you.
Thank you. Most of the things have been said. I have been working with PyMC for a while right now, and I'm pretty convinced how powerful can be the whole Bayesian framework and PyMC Labs to address some problems that are traditionally addressed in other ways in economics and finance. And I have been working on that. I also have been consultant for the OECD. And right now I have been working with the labs in some of applications that we're gonna share with you. So very happy to be here. And yeah, really excited.
So today we're going to talk about Bayesian AI for finance. The Bayesian part is about the power, and that has always been true, is like it's just a very powerful methodology to build complex models flexibly. And with AI, we can couple this to make it a lot more user-friendly. And this has been, I think, the mission from day one with PyMC, but even as you will see, PyMC is kind of difficult to use, but with AI, I think we can make that even easier. So I already introduced myself, and just a few more notes on PyMC. So it is the most popular statistics package in Python, and with over 500,000 downloads every month, and just very actively developed by a large community. So this isn't my project. This is really a huge community effort, and I'm one of the co-authors. But by now, like, there's people doing a lot of work, like Ricardo Vieira, and also, of course, Camilo, that are contributing a lot. And what has always struck me with this framework is just how versatile it is. It has been extremely helpful in my PhD during when I was building models of understanding how the brain creates behavior. But also then switching to Quantopian, I found this to be an extremely versatile tool for solving the problems we had there. So if you're familiar, this was the first crowdsourced hedge fund. And the idea was to, from like these millions of strategies we had on the platform, how to select the best ones to tie them together into a hedge fund. And Bayesian modeling, with its flexibility of modeling return series and signals, was really powerful for selecting those strategies and then tying them together into a portfolio. So for portfolio budgeting, it is extremely powerful, but that's not the only thing. We will talk about other type of problems where in quant finance, where Bayesian modeling is very powerful. We don't just develop PyMC. There's PyMC marketing with marketing mix models. There's a causal pi package for experimentation, and then Decision AI, which is something new that we're very excited about sharing. We will have a quick demo at the end. At Labs, we work with a range of clients, quite a bit of marketing analytics. So HelloFresh, we help them with their marketing budgeting. We partner with Bain and also Colgate. So you see CPG and marketing, also life sciences, but also quant finance. So we're working with hedge funds and other finance companies to help them develop these types of models that really sets them apart from what most of the industry is actually doing. Like, a lot of people are doing machine learning and just classic statistics, but Bayesian modeling is still, I think, pretty rare to see. So obviously this raises the question, well, why is that? And why is Bayes specifically powerful for finance? I'm glad you asked. Well, when we're talking about finance, we don't get around to talking about risk, right? There's few fields where risk and really specifying, quantifying risk is more important than in finance. So finance is the study of risk, and financial analysis is the study of decision-making under risk. So no field stands to benefit more from the uncertainty quantification offered by Bayes analysis. And now we're in very exciting times because the tooling has become so advanced and sophisticated that we can really build these very complex financial models, and we will show something that's very complex, and then get inference from them and build these models quickly, and then even with AI, make it even more user-friendly. But with PyMC already, you can like build these algorithms and use them across a range of scientific fields and disciplines. And of course, today we'll talk about finance, which actually has lagged behind in this way. So as we postulated, finance is basically decision-making under risk. And when we're talking about risk, the other side of that coin is uncertainty, right? How do we know that what we measure is actually the true value, the truth? So uncertainty is just inherent to, well, everything, but specifically markets. And every financial decision involves navigating unknown future outcomes and market volatility, right? So we're always just drowning the sea of uncertainty and noise, and the signal is so very narrow that we really always need to pay close attention to this trade-off, the signal to noise ratio, essentially, and see whether the edge we think we have, whether we actually have that, and whether that rises above the noise. And traditional modeling approaches usually have very restrictive assumptions, right? So for example, when you're doing classic, say, frequentist statistics, oftentimes there's implicitly a normality assumption baked in, right? And we do know that that is definitely not true, right? Like, financial returns are not normal distributed. If you apply those models, then you definitely will get misestimation. How much misestimation? Well, you don't really know. And also they have fixed parameters. For example, if you're machine learning, right, there's just like one set of parameters that you're estimating, and it's going to be one prediction, and there's no uncertainty in any of it. And neither of those match the market reality. So Bayesian methods are different in that they provide you building blocks, like Lego building blocks, to build these models out of probability distributions. You might call it the natural language of uncertainty. And here we really embrace and quantify uncertainty in everything we do. So in Bayesian modeling, we have uncertainty as a first-class citizen and carry that through from the specification of the model all the way to the results.
So just a very notional introduction. So, well, what is Bayesian statistics? Like what does this framework do? First, this is very important. We assume explicitly, or we present explicitly, the fact that we have beliefs around what we are studying, and we encode those beliefs as probability distributions. But we update those beliefs, we confront them with data, with the data we are analyzing, and this generates a posterior distribution, which precisely combines our prior beliefs with the data and what the reality is showing to us. And this provides us with one of the most powerful elements of Bayesian statistics, is that we obtain a single universal estimator that is valid independently of the conditions. Like, we don't have these very restrictive assumptions that we are normally facing in traditional statistics. We obtain, and we will see in some detail, a universal estimator that can work in multiple conditions, especially in conditions that we can see in financial markets. So how do we think finance can obtain benefits from Bayesian approach? There are three main benefits. The first one, which Thomas already mentioned, is that we can quantify uncertainty. And that's very important because we can assign specific values, translate it into probability distributions. And as we know, well, the level of risk, once we quantify it, we can measure it and we can price it. And that's extremely important in finance. Then we can go beyond traditional econometric assumptions, which are always very restrictive, and that is normally not explicit to most of the conclusions we obtain from those kind of frameworks. And then, as we will see, we can handle complexity with a stronger framework, which allows us to use different advanced mechanisms to face complex nonlinear patterns and model in a better way time series dynamics. And I will start with probably like the most basic model that we can see in finance is like we have a CAPA model, capital asset pricing, and we can normally estimate a capital asset pricing model with a traditional frequentist approach, in which we just run an OLS regression, and we'll obtain just one value and assume that's the reality, and like try to manage and optimize our portfolio based on that. But we can also approach this very simple problem with a Bayesian regression, in which we will obtain not just one value, but actually a whole distribution of that value. And what are the possible values according to this distribution? And what is the uncertainty and the probability assigned to each of those values? And that can be incorporated in the risk measure, and that can help also in the risk management process. And I am including some code of the examples. My goal is not definitely like for you to digest this in 3 seconds, but is to give you a rough idea of how an implementation, for example, of a very basic capital asset pricing model in PyMC can look. We initialize the PyMC model, we add the information, we set the priors, we assign some initial values we consider reasonable, and then we assign the likelihood using a normal distribution here. And we will see some examples of changing this. And then we sample the whole thing to obtain the final probability distribution. Now, this is very important because normally probably one of the most misunderstood concepts in statistics in general is the notion of confidence intervals. With Bayesian approach, we actually obtain the whole probability distribution, and we can obtain high density intervals, which actually indicates the probability of the value lying under a certain range, where the confidence intervals actually does not give us that information, even though it's commonly misunderstood. And we can obtain these fully interpretable distributions and assign precisely risk pricing to these different values. Then one of the most important elements, and this is highly powerful in the case of the framework, in the Bayesian framework, is that we are not restricted by these normality assumptions, and we can actually model very easily phenomena in which the data doesn't follow this pattern. And we know that in finance, that's not true. Most of the financial returns, for example, have particular long tails, they're skewed. And here I'm showing an example of how a traditional OLS regression, when we violate this assumption, is very easily biased in terms of the estimation. While if we incorporate in the model, and we will see how to do it, a very simple modification to the probability distribution we're using to model the effect, we can actually replicate and obtain the actual value. And this is very important in the case of financial markets, where, as I said, we normally have heavy skews and heavy tails, like long tails and skews, and we can incorporate this very easily. Here we have also another simple sample, and I will show some how with a very small change in one line of code, we can replicate actually these parameters, and we can actually sample data and obtain the correct distribution according to what we are observing in the data. Here's the simple example. This is very similar to what we saw previously. We initialize the model, we add the priors, and then we add the likelihood, but instead of adding here like a normal distribution, we just use the skew normal. And with that change and some additional small parameterization, we can have the Bayesian approach to consider these different probability distributions. And there's a huge amount of probability distributions, some very exotic, that we can use to model different data patterns. And this is extremely powerful and relatively simple. Like you can actually with PyMC get access to a whole universe of probability distributions that can adjust to the reality of the phenomena you are modeling. This is particularly relevant in the case of finance. But this can be applied to other widely used tools in the context of financial markets. One very common is the value at risk. Then if we consider again that most of the value at risk analysis use the assumption that the data is normally distributed, we will see that this gives heavily skewed results, like heavily biased results, because we are not actually using the real distribution of the data. If we, in contrast, apply a Bayesian value at risk approach, where we can actually model the distribution of the returns using other probability distributions, we will be able to take advantage of these features and actually obtain more precise estimations and more robust ones. This can also be incorporated for option pricing, where we are able to propagate uncertainty into the different phases of the option of the derivative pricing. And we know, for example, that Black-Scholes normally assumes a fixed volatility, which is not necessarily true. With a Bayesian approach, we can modify this, and we can encode the volatility of the option pricing as a probability distribution and propagate the uncertainty through the whole steps using the Monte Carlo simulation integrated in the Bayesian sampler, in the PyMC sampler. We can obtain pretty interesting results here and very powerful. Now, I want to do a small dive into how PyMC provides very useful tools to model complex structures. We can use hierarchical models, which basically are model relationships across multiple levels. We can also add different time series mechanisms using state space models and hidden Markov models, which capture temporal dependencies and regime changes in financial data. And we can use Gaussian processes, which I will dive in a minute. We are very flexible and powerful tools to capture nonlinear relationships in data. Now, in terms of Gaussian processes and HSGPs, well, Gaussian processes are basically very powerful non-parametric models that model the relations between different data points using the covariance matrix. So basically, in very simple ways, we try to model the behavior of data instead of estimating one particular parameter. We're trying to model like the relationship using the covariance matrix between all the data points to understand how some particular variables change as we move between different points of the observations. And then we have the possibility of also applying a simpler version of the Gaussian processes in PyMC Labs, which is called Hilbert Gaussian space processes, which allows us to obtain these powerful estimations by using a smaller amount of computational power. And I will show just a very simple example to make this a little bit more concrete, which is the use of GPs and HSGPs in geospatial data to being able to capture geospatial patterns. This is a work I have been doing with the OECD and I will share, but this can be bridged to financial applications. So to share this example with you, we have been modeling, for example, the occurrence of hydrometeorological disasters in several countries around the world. And this is something interesting because we can see that at the end, map information or geospatial information is basically, you can understand it as a 3D kind of relationship where you have latitude, longitude, and a third variable, which we are modeling, which is the probability of disaster. And the map actually doesn't follow like the traditional linear patterns that we're used to model with traditional frequentist linear models, but is very prone to be modeled with nonlinear estimators like the one we are seeing in the HSGP. So basically, we are interested here in modeling for every point in the map in a country, what is the possibility, the probability of a disaster happening. And here we see like are the maps of a set of countries in Southeast Asia, where we have like these points where are historical disasters that we had. And we know that this is highly correlated with the river proximity. So we just basically feed an HSGP, which is a Gaussian processes with a simplified approximation. We feed it with just this information, the latitude, the longitude, basically the coordinates, and the past events. And we ask it to estimate the probability of a disaster occurring there. And using only these informations and the previous disaster location, the HSGP is powerful enough to uncover risk patterns caused by rivers. And we can see, this was very striking for us, we can see that it actually discovers by itself some of the river trajectories without having any information of the river location, just by using previous disasters and the covariance matrix of these observational points. This has a direct connection with financial applications, and I wanted to share this because this is a more visual example of how this can work. First, it is very powerful to capture unobserved variables and unobserved patterns, something that we can sometimes have in finance. And it's very powerful to model nonlinear structures and nonlinear relationships, and sometimes also to model simplified approaches when we may be missing some of the covariates. And this is a little bit more complex. I'm not going to jump into how like the GP or HSGP modeling looks in terms of code, but basically we have to define a set of more complex parameters related to the covariance matrix and how we want to model it and approach it. But now, knowing precisely that sometimes facing a modeling code and like all the expertise that this requires can be complex, PyMC Labs, as Thomas mentioned, has been developed a very powerful way to connect these applications with the powerful framework of PyMC. And that's where the decision AI enters in. We have been developing these tools that allows us to go very quickly from static code to a more dynamic interaction with our models using basically AI, in which we can talk to the AI and guide it to produce this kind of mechanism. So we basically are driven by user asked questions. We, in terms of natural language, can post questions to the model, and we will have a set of AI agents in the background working together to compile, to develop these models and answer the question using the framework of PyMC. This is translated into outputs with intuitive charts, risk, and metrics. And you can also interact using language approach precisely to drill down and obtain like deeper answers of what you want. So basically, you are now able to exploit much of the PyMC and Bayesian framework without the necessity of being expert and spending thousands, hundreds of hours like Thomas and I have done during several years. And this is very useful because it basically provides the power of the Bayesian framework to a wider audience. Okay, so here we have an interface, and we will start with a very simple exercise. We have some predefined portfolios, for example, that we have, like in terms of, well, conservative growth, balanced, diversified, aggressive growth. We can he's here, and we're asking it basically to give us the projected return of this portfolio, and we can see how the different agents are working in the background to provide some answers.
And to add a bit more flavor of what's happening here. So basically, the user entered this question. So the focus here really is, as the name implies, on decision making, right? So what is it really that you want to know, right? And like everything we talked about before was always in the service of something, right? Like, why build a Gaussian process model or skew normal model? Well, you have some kind of question, right? You want to understand something, you want to trade something, and that's where we start with this. So what usually comes at the end, right, of like this entire process, here comes at first, right? So here the example question is, what's the projected return distribution of the conservative growth portfolio? So something that's more balanced with these things. And then what happens as you enter that question, there is a set of agents, and these agents are good at different things. So there's like a data loading agent, a data cleaning agent, a data exploration agent, a model fitting agent, right? A model creation agent, a model interpretation agent. And all of those are capable of running Python code, right? So they're domain matter experts in quant finance, and they have knowledge of the individual thing that they are doing and good at. And then there's an orchestration agent that like is basically shepherding this entire workflow through, and first giving it to the data loading agent. It knows where the data is, what type of data is required, and then that agent executes Python code. So this is connected to like an execution backend. Think like code interpreter, right? But just like richer with domain expertise. And then that is running the code, the Python code, to do that. And then just as the analysis is complete and it's figuring out like, well, what type of model should I even run, right? And what is the right framework? So all this work that we talked about before, that before human was doing, now like the AI can support and assist in doing. And then once we have this artifact, the question is, well, how do we interpret it and how do we work with it? And that's where also AI is extremely powerful in giving this chat interface to ask questions and provide rich outputs, as you're seeing here, that allow you to really dive in and understand things and ask follow-up questions, right? So that's really the power of this approach. Yeah, and you can see like on the left side, we have different follow-on questions we could ask. Below that, you see that workflow that I was talking about. And then on the right, you see something that looks like a dashboard. And I guess it is a dashboard in a way, but it is dynamically created, right? Like this is created for you on the fly for that particular question. If you would have a different question, well, then the entire agentic workflow would have looked different and the outputs would have looked different, because that is what would have been the most insightful thing to produce to you. So just as like a bit of overarching theme. And now I think it'll be interesting, yeah, to like look closer into what that actually could look like for that particular question, Camilo.
Sure. So in this case, we have like the decomposition of a particular specific portfolio, and it with a couple of clicks, it's able to produce like this visualization where it is showing like, well, which are the top contributing assets to this portfolio in terms of returns, what are their weights, what's the return contribution, which assets are generating losses for this particular portfolio. Also, well, we can see like, well, what's the portfolio distribution in terms of weights. We have stocks, for example. We can dive in, and this will provide us like division by different sectors, economic sectors. We can also obtain here like the high density intervals in terms of the possible returns, in terms of the expected returns. And we can see also a time series projection of the whole process. we can also, in this case, we include very quickly a Gaussian process analysis in terms of the risk and the possible returns, and also visual representation of the portfolio covariance matrix. And the point is that, as Thomas said, this process in an ordinary workflow in the past would have taken at least a couple of months or maybe at least several weeks to develop. But with this technology, we're able to provide actually tools that can deliver this in just a couple of hours of processing the requests and determining what we really want. And you can have actually instantaneous results. And this is extremely powerful, but it also helps bridge the gap between the application of powerful Bayesian tools and more user-friendly interfaces, because we know that sometimes PyMC can be challenging. It's definitely a complex application, very powerful, but with this kind of tools, we are able to provide it to a wider user audience. So I think that's kind of a general overlook. I don't know, Thomas, if you want to add something else.
Yeah, and so the way that we're thinking about this, I mean, one is, so we're planning on open sourcing the core technology. PyMC, of course, has always been open source, right? And you can think of, well, and the way that we're building this is probably that there's like two different type of modes, or I mean, you can like flexibly switch between them or they're integrated, but one is that what we're finding is AI agents are capable of like building models on the fly, but not really as much from scratch, right? So that is still like something very daunting. I mean, this is what people come to PyMC Labs for, right? It's like, well, I have this idea, this problem. Can you help me build a Bayesian model? And then the PhDs at PyMC Labs get to work and build these models that Camilo was showing. And that is still very hardcore research. But then there's the problem of running this in different scenarios, right? So adapting something existing on the fly to a new data set or a new set of questions that you have. And that AI is definitely capable of today. And then even more importantly, once you have run the model, right, it's like, how do you get insights from the model? And we find that this is like a big challenge for the models that we're building, right? Like they're these amazing and beautiful artifacts that really have all these insights in them, but the question is, how do you get them out, right? And with this AI interface, we can teach the AI basically what the model is, right? So, and can explain it to you, but also how to work with the model outputs and create these rich outputs to then really provide the insights. And we find that AI is extremely powerful at that part too, where the posterior distribution, right, that we're talking about, how do you inquire into that? How do you get the insights from that? Even that is like really difficult for a stakeholder, right? Like if you're doing this and you're not like technical, it'll be very, very hard. So this is a much more direct way of interacting with it. And before you click on that, Camilo, what's also really cool about these interfaces is that here we are showing that this is very high level, right? So if you are a stakeholder or you're working with stakeholders, decision makers, they have this chat interface. But if you are more technical, right, there's nothing prohibiting you also from like drilling down directly into the data or even into the code, right? So if you ask it for like, well, what actually is the code that you use to like create the portfolio, you can look at it, you can edit it, you can interface with it. So with AI, now we're able to build these interfaces that for stakeholders and non-technical users as well as technical users. So bridging the entire gap, because everything is happening on demand, right? Like you just ask it and it produces this for you in the way that you asked, and we get a lot of flexibility, something that wasn't possible before. So that's why I'm very excited about this technology and how it integrates with Bayesian modeling and just makes it a whole lot more approachable, a lot faster to gain insights, and just a lot more usable and easier to get insights and thus create more value.
One thing I wanted to ask you while you were on this topic, can you explain a little bit more where the Bayesian is integrated and where the other pieces that do not employ any Bayesian theoretical framework or analysis? So for example, if like, is it the case that I go to this machine and I give the interface or the AI collective agents my information and the type of risk that I'm tolerant about, or some other characteristics of my sort of financial behavior risk tolerance. And then they take this, somehow do also Bayesian analysis to come up with something, or is it that they do the separate thing and Bayesian analysis comes at the end when the portfolio is already in place?
It can be either. So you definitely, the first use case you described is probably the primary one, where you have a set of constraints or questions, and and in the interface, basically there's like, you can think of like a database of models, right? Like all kind of different things, like a portfolio construction model, a return prediction model, and the different agents basically are able to like understand what it is you want and then choose the right model from this template, adjust it to fit your use case, right? So you have like your own constraints and it's able to configure that, run it, and then produce these outputs. But also then if you have something that you want to just analyze, right, and you have maybe outputs from another model,
Right.
you can also just have those be like basically build a Bayesian model around that to interpret the outputs of that and get uncertainty estimates. So there is a lot of flexibility here in terms of like how you construct these systems and then how you use these systems.
And does it get integrated into, so for example, lots of other systems you see that they use sentiment analysis, they use news, they use certain source of news that maybe you fit them or they find themselves, and then eventually get something out of that in terms of recommendations, also in terms of possible risks associated with each one of them. But of course, you don't know what kind of analysis they have done. But do you also have that integration, that like the external integration?
Do you mean that like if there are these other data sources,
Other data
like
sources
sentiment, for
or
example?
other like places that may bring additional constraints or additional, like imagine that I have taken some piece of news and I have added my own feeling about Tesla, and I have taken some piece of news about Tesla that is recent, but I haven't looked at the most recent SEC filing information. Is the system going to do it on its own, or is the system can be integrated if I wanted to look at the 10Q, 10Q, whatever reports that are available through SEC or other places?
So you can, so two things. One is through the chat interface, you can like in principle just like specify either of whatever it is you're looking for. So you might start with that investment hypothesis, right? Where like, well, this idea of Tesla, this is like the most recent sentiment data that we have. Here's the most recent news articles on this. And that might be an agent, right? That like is able to like really extract sentiment and work with that. So that could be data source, and then of course layer that in with your own interpretation, and it'll help you just like interpret that and put that together. I mean, AI can do that today. It's more a question of like piping things together. And that's also something I want to highlight here, is that what Camilo has shown here is just like one possible way of building this. So we're thinking of this much more as like building blocks and different concepts. The particular one here is not like, this isn't like a finished product that like, oh, just like here's the thing and like sign up and then you can use it. It's more conceptual, where like, well, this is the type of system that we can build very flexibly and quickly now and tailor it to whatever use case you want, right? So mainly we are a consulting company, right, that is building bespoke solutions. So if you care mostly about sentiment of like individual stocks, and that's then the system basically will be built in a way to most ideally support that type of workflow. And then once you have that system in place, you can lay on additional agents, additional functionality, and cover more and more complex workflows. But probably you want to start somewhere small, where like maybe you just start with like, I mean, if you're very conservative, we build systems that are much more complex. Maybe you just start with like the sentiment agent or like the data cleaning agent, right? It's like, and then you build these longer pipelines and more rich functionalities.
Yeah, that's wonderful. That's fantastic. I haven't seen anything quite like this, Like aside from the Bayesian analysis side, which is the novelty, but also the fact that what you're describing sounds like, at some point in its more advanced way and shape that it will get in the future, is like you have a menu of these agents at your disposal and you build your own hedge fund, so to speak. You bring a data analyst agent, you put it there, and you click on the other one, you put it next to it, and build your pipeline only with, I don't know, the sentiment analyst and this other analyst, and of course the supervisor agent. And then it puts, whatever that you want, and then you take that and do the analysis and risk management and so on. Yeah, that's quite something. That's quite something.
Yeah, I really love the way that you describe this, and that's exactly how to think about this, is basically like a quant hedge fund in a box, right? I mean, that would be one way to go down, right? And I mean, hedge funds today are built like this, where they have an alpha team that is just like finding signals that have power, and then there's like an alpha combination team that is like, how do we weight these different and tie them together and create these aggregate alpha signals? And then there's the portfolio construction and risk, right? And then trading. So all of these, I mean, it's like building a strategy is a very complex process. And each of those, right, we will start with just layering in more and more AI, particularly for that thing, right? So I think the critical thing is the domain expertise.
Yes.
And that is a key difference is,
yes.
I mean, GPT-5 and Code Interpreter can already do a lot of things, but when you really use it for a particular use case, you often find that it lacks context and it lacks domain expertise. So layering in the information about quant finance specifically, but also from your organization, right? It was like starting with where's the data, but also like, well, what are the other things that are happening in other parts of the company, right? Like, is the core around sentiment, or is it about like data sources or whatever, and then build these systems flexibly?
Yeah, that flexibility is amazing because you essentially, whenever you build something in any one of these places, as far as I can tell from outside, is that there is a very rigid, not rigid in the bad sense, but rigid in the sense that otherwise will become extremely inefficient. If one day you were thinking, oh, let's do sentiment. The next day you come in and you say, oh, why don't we do ESG? Then now let's do macro. So there is no way that you can ever possibly do anything good out of that. But with this, and I'm not saying that necessarily with this, that is a good thing to do, but at least there is the possibility of experimenting with that and saying that just give me the macro level things and just help me with, whatever strategies I can come up with in that space and so on. And which is really amazing, really amazing. So I'm going to ask maybe one or two and then leave open it to the audience for all the questions that they might have, and I'm sure they do. But one thing I wanted to ask is that have you done any experiments with the things that I believe I have never done any Bayesian financial data analysis, but I know that there was a group on Quantopian when we were doing LLM research. We got very much interested in a paper that was combining the LLM with the Black Litterman model. Black Litterman model has this notion of views, and the views were going to come from the output of these LLMs. And Black Litterman also probably is something that maybe is the oldest Bayesian serious type of model that anybody, old timers, will talk about. So anything in that space, how do you see that? Like the things that exist, what does your platform talk or do about those?
Yeah, so that's a great point. So the Black Litterman indeed is like the thing that's not at all, and it's interesting to see that this is a Bayesian framework implemented expressed in a Bayesian framework, and I think that actually was lost. Like people talk about Black Litterman all the time, of course, but the Bayesian roots have largely been forgotten and haven't been shepherded through. But you can just stay within that framework and really, and at Quantopian actually we have done that, and from Black Litterman, like basically then like really layered in all the other richness from these. For example, there we were modeling financial returns, right, which have, as everyone knows, like volatility clusters. So during times of market stress, there's high volatility. So the thing that Camilo was showing with like the Gaussian process, that's exactly how we modeled the volatility. There are other approaches like stochastic volatility, but GPs actually are very uniquely able to do that because you have a lot of flexibility in how you create it. And this all like basically is then available to the AI. So there's like a RAG type lookup where it can retrieve the most relevant information at any time point and then use that in providing the answers and the models. So that type of information is basically available. Well, if you make it available, which we do.
Right. So any questions by anyone?
Yeah. First of all, thank you, sir, for organizing this event. And Thomas, it was a great event, like a great insights and great work. So I want to ask that can this be used for finding the most effective financial tools on some certain like some certain stocks or certain symbols? Can we like find a probability of which tools or like which ones would work the best for some certain parts of the market? And can like those be converted to IMC based models or code? Can those models be converted to PyMC based code?
Yeah, thanks for that question. So that's exactly the right way to think about this. So you can imagine that maybe you have a general purpose model, right? That like gets some particular type of analysis, like maybe that's a sentiment analysis, and it knows how to run sentiment analyses on text input or whatever. And that is general purpose, right? And we only have to build that model once. But then you will want to apply that to a particular sector, a particular stock, something that you care about, right? And then either you can like do the traditional way where like in Jupyter Notebook and like coding and like taking a library or some code that you've written and then apply it and it's right there, or just like have the AI apply it to that particular use case that you care about. So that's exactly, I think, the most powerful way to use these systems today is to have models in a template, in a model zoo, essentially, that the AI knows about. You don't have to know about it. And then it will on the fly basically apply the model in the right way to your particular problem and then like able to interpret the outputs. That's the other critical piece, right? Is you don't even have to like really then dive into the outputs and understand those. It will know basically how to interpret them and sort of common ways to look at it and then present those plots, but also the insights where like, well, the sentiment here is trending up and this matches with what you have provided as input. So we update our aggregate signal to like a strong buy, for example.
Maybe if I can add
And
something very, very quickly, I guess that you can see that PyMC actually provides a wide range of models that can be applied to very different kind of problems. In this case, different kind of asset analysis. And precisely what you asked is what you can ask to the AI system and to the whole interface we offer. Is like, for this specific problem, which are possible approaches that I can take from the Bayesian framework, and well, can you please run them and rank them according to the results they are providing for this specific problem? And that, which was something that could take, as I mentioned previously, several hours of work, now can be done in quite a reduced period to evaluate different options.
So one quick thing, and then maybe we will have time, one more question, the last question, and then we call it a night. But for people who wish to experiment with the platform in the current version and the upcoming things, what is to be done? How can they do that? Is there going to be pricing rates or free or however? So one question is how people can experiment and have interaction with the system that you described. And the second is if there are students, researchers who would like to contribute to this field on the side of the Bayesian analysis, widely understood, what would you recommend for them? Starting points, books, papers, things to do, tools to play with, things like that.
Yeah, so I think in general, if you want to get started on Bayesian modeling like PyMC.io, maybe Camilo, you just want to bring that website up real quick to show people there's a lot there in terms of the documentation, and there's books there, there's like all kinds of things. So if you go to learn at the top, then There's for beginners, intermediate, also there's a very rich example section. So if you click on examples, there's like all these different notebooks on different things you can do with the library. So this is really good just to get general overviews. On the right side, you can see there's GLMs and case studies and causal inference and Gaussian processes and time series, right? So this is obviously very important. And just like browsing through this and just anything that you think is interesting. And then if you click on, I don't know, maybe go to time series on the right side. And then, yeah, just like the AR one, for example. So AR one, most people will be familiar. And then it really like walks you through the model, the code. And so these are like all applied examples. And that's a great way to get started. And then if you want to contribute, there's because it's all open source, right? On GitHub, there's like issues, and we have a discourse forum where you can ask questions. So definitely, yeah, do get involved. And there's a great community of helpful individuals and developers. And we're always looking for contributors.
Perfect.
Joshua, do you have a question?
Yeah, so I'm with the University of Texas. I'm a second-time grad student. I'm finished a bachelor's in math and a master's in data analytics, did some work as a data scientist a few years, and then I came back for a master's in math that will probably roll into a PhD, trying to really focus on financial mathematics as my research focus. But I'm part of a student org called the Investment Society, and we have a pretty strong like financial backing with some industry partners. So on one hand, we have like a 2.5 student managed fund that students, contribute to, but it's a little bit more traditional, securities analysis, more from a finance standpoint. But because of my coding experience, I'm one of the executive board members for our org, and I've really been, I built out our first org GitHub. I've been interacting with other math and stats courses. So there's a Bayesian statistics course that I had a nice dialogue with that professor, and he was specifically asking like where we could, find, opportunities to have finance applications for his coursework. So I'm super excited just running into you guys. I'm definitely going to highlight your site. And then I already was running, I think, an AR1 model with PYMC and get some good results terminal. So I, pretty much mapped out a way that we can integrate it with Python, and I've been doing all sorts of cool Python stuff with it. But yeah, so I definitely would be excited. I'm hopeful to reach out to that professor. I'll definitely reach out over email. But this material is fantastic because then I can have a more methodical kind of building blocks for some of these students, and hopefully, they have a student course project at the end of the semester. And I was hoping to have them tie some of their work within the finance arena. So I'm sure that I can probably get some of them to piggyback off you guys' notebooks and maybe have some interesting use cases that, we can exchange with you guys over the long run.
Fantastic. Yeah, I mean, that's a really impressive background, and sounds like you're involved in some really cool projects. And we do partner with universities and certainly like students and supporting students and research is close to our hearts. So yeah, definitely drop us an email, info@pymclabs.com, or just be directly thomas.wiecki@pymclabs.com. Always looking to collaborate, and if there's like any way we can support this, I'm happy to chat.
Awesome. Thank you.
All right. Well, thank you very much, Thomas and Camilo and everybody who came and joined us, and everybody who will be watching this on YouTube. So you heard what Thomas said, and I think that this is a wonderful place to get started. And through there, you can find the articles, the papers, books, or whatever direction you want to do, however reading you want to do, however playing you want to do, and then contribution, tons of opportunities to contribute as well, to build even student groups, discussion groups, as Joshua was talking about, work groups, reading groups, all sort of activities that can be centered sort of around this particular topic, which is a very interesting topic and has been. And the good thing about this, on one hand, is a bad thing that it was ignored in the community of finance to the large degree, the whole Bayesian approach to things. But it's a good thing because there is a lot of room for newcomers to contribute and to add material, to have lots of work and thesis and publications or programs, anything that comes out of that. So good night to everyone. Thank you very much. Good morning to Camilo. And take care, and hopefully we will talk again. Thank you. Bye.
Thanks for having us.
Thank
Bye.
you,
Thanks.
guys. Appreciate it.